All right, everyone. Good afternoon. Welcome to today's webinar. It is noon here on the East Coast. My name is Jerry D'Ambrosio. We are live coming at you from Charlotte, North Carolina, where I only had to wait 20 minutes today to get gas. Not too bad, but it is a disaster out there if you guys live on the in the southeast area, North Carolina, South Carolina, Georgia, anywhere in this area. You guys know how difficult it's been over the last couple of days. Pierre doesn't live in this area. Pierre says hello from Belgium. Wow, welcome, Pierre. I want to welcome everybody joining us via either GoToMeeting or YouTube as well. We are streaming live on YouTube. And I can't think of a more timely webinar than this one that we are going to deliver to you guys today. How to know when to sell your stocks. Very timely. It's been a pretty difficult market, I think, not only today and yesterday, but really over the last 3 months. I was looking at a VectorVest composite market timing graph yesterday over the last 3 months, and essentially, if you guys do that, we've been moving sideways. Really haven't gone anywhere over the last 3 months. And 3 months isn't a very short period of time. It's a quarter. It's 25% of a year. So it's been a difficult 3 months, and I'm getting a lot of emails from our clients that are asking, man, what do we do here? This is a pretty tough market. So I'm here to help you guys kind of navigate through these difficult times. Derek says, hello from UK. Are you experiencing the 70s fuel crisis? Not necessarily, no. I don't think it's going to get that bad, I hope. But there has been some shortages and people running for the pumps and filling up. And I know that's not advised, but boy, hate to be stranded on the road with no gas. So I did fill up. I was a half a tank. I filled it up to a full tank. I just want to get myself through the weekend. Hopefully, and what I did read today is that it might clear up here over the next couple of days and things get a little easier. Okay. Bill says, great to be here. East Tennessee gas shortage is spotty. Didn't have much problem this morning. Good. I found one. I was driving around for a little bit this morning after I dropped off my kids at daycare, and I found one gas station. I waited in line for about 20 minutes. Not too bad. But again, guys, my name is Jerry D'Ambrosio. I am the manager of educational content here at VectorVest. And I am just one part of our education department. And our number one focus is to make you guys better traders and better investors through the education that we provide within the VectorVest program. And this is the truth. I wake up every morning, I get to my computer. I do work from home these days. I get to my computer, and the first thing I think of is, who am I going to help today? How am I going to help? I go through my emails, and I get a lot of emails on a daily basis from from clients, from former students of courses that I've taught, kind of asking me and for some advice and insights on the market, and I could speak for everybody in the education team, and frankly our whole company. And that's our number one goal: make you guys better traders, make you better investors, teach you the VectorVest program, and again help you navigate through some difficult times here. And last couple of days have been rough. News came out, inflation's at a 13-year high. Earnings season wasn't all that bad, actually pretty good, but inflation's jacked up a little bit, and the NASDAQ stocks, which are most of the market, right? You got the Dow, the S&P are just a couple of days off of all-time highs, but that's 530 stocks. NASDAQ's a few times more than that at least. So tech stocks taking a big hit. So it just feels like the overall market's been struggling, and it has. But again, very timely webinar here today. Talking about knowing when to sell stocks. We're going to go into a few different things. Not only knowing when to take profits, but how to set the right stop loss. We're going to talk about an indicator today that we haven't really talked much about or taught a lot, which helps in both of those respects: taking profits, and then also position sizing and setting the right stop loss upon execution, upon trade implementation. Okay? All right, so just a couple of things first that I'd like you guys to do for me. Grab a pen, piece of paper, something to drink, of course. You know what? We're going to be doing some math here today. So grab a calculator if you have one. If you're at your computer, you just grab your computer calculator. Here's what I'm going to be using. Here's my calculator that I'm going to drag off on the other monitor because we are going to do some math here today. I hate to disappoint those of you that didn't think. You had to think today, and just listen. But we're going to be doing some math here today. So grab a pen, piece of paper, something to drink. Number two, get rid of any distractions. You're here for an hour. We're going to spend about an hour together, and I really want to applaud you guys for joining me here today. I mean, it is noon here on the East Coast of the United States on a Wednesday. So you guys are all ready to learn, make yourselves better traders, which again, I applaud you for doing that. Okay, so one of the things we're going to discuss today is how to account for volatility when managing trades. We have maybe different portfolios, right? I hope you guys have different portfolios that you're managing. A retirement portfolio maybe, where there's a certain type of stock in that portfolio, a certain type of analysis that goes into the stock selection for that portfolio. A lot of is fundamental valuations, right? You focus on earnings per share and earnings growth rate, maybe sales and sales growth rate. Maybe a lot of those stocks in that portfolio are dividend paying stocks. Then you have a portfolio where you have money set aside where you may be trading a little bit more actively for swing trading, and it's a different type of stock that is in that portfolio where you do want to overlap and pay attention to fundamental valuation, but it's more so technical analysis that you are focusing on for stock selection for that portfolio. So what we're going to discuss here is how to account for volatility when managing any trade, whether it's a short-term trade or a longer-term investment. Trade implementation begins with good risk management, okay? And we're going to go through some guidelines here, some tried and true, I feel gospel type guidelines where you really should be following no matter what type of portfolio you're trading or managing, okay? We'll also talk about how to size each position. So I know the title of this webinar is how to know when to sell your stock. So we're going to, of course, talk about that, but we're going to talk about position sizing as well. This is very important for anybody, whether you're an investor or a trader. Not only we'll discuss position sizing, but setting the proper stop loss as well for every trade. Okay. And this is what we are going to focus on here. This risk management tactics, formula, on how to set the right stop loss. You guys have heard the 1% rule or the 1 to 2% rule, right? Essentially, how it goes is don't risk more than 1 to 2%, and we're going to stay closer to 1% here, of your overall portfolio value on any single position. That's not to say if you have, let's say, a $30,000 portfolio, you're not going to invest $300, which is 1% of $30,000 into every trade. No, we're not going to risk any more than 1% of our overall portfolio value on any one single trade. So we're going to assume moving forward here today that we are going to be managing a $100,000 portfolio. And what is 1% of $100,000? $1,000, right? And again, I'm not saying we are going to invest $1,000 into each position. We are not going to risk more than $1,000 per position, because that is 1% of $100,000, right? So let's kind of go through the calculation here where S is our stop loss percent. So we're trying to solve for our stop loss percent. So essentially it says, so with 5 positions and a $100,000 of our capital invested, we should be using a 5% stop loss. How does that work? Okay, so $100,000, 5 positions, $20,000 into each position. If I don't want to risk more than, or not going to risk more than $1,000 each position, what's $1,000 of 20 grand? It's 5%. Okay, if you're saying, well, 5% is a little tight. Okay, what can you do? You increase the number of stocks that you're going to buy. So with that same $100,000, instead of 5 positions where you put 20 grand into each position, you manage 10 positions where you put 10 grand into each position. You're still not going to risk or lose. Risk, lose, the same, go hand in hand. You're not going to risk any more than $1,000 into each position. So with 10 positions and $10,000 into each position, what is your stop loss percent on each position? That being the case, well, it's 10% now. Okay, so it really depends on how many stocks you're looking to, the number of positions you're looking to trade, the percent of capital employed, because the risk on any single position is going to be the same. It's always going to be 1%. It says 1 to 2% here. We're going to, again, try to stay closer to 1%. So moving forward, that is our assumption here. That is what we are working with. We are going to be working with a $100,000 portfolio. And this is a little bit of a different webinar here today, guys, because I'm going to be in the program a lot, actually moving in just a minute here, going through charts, going through some stocks. So let's all assume with each stock that I go through, we are working with a $100,000 portfolio and we're going to hold 5 positions, not risking any more than 1% of our overall portfolio value on each position. Therefore, we're going to be using a 5% stop loss. Is everybody with me so far? And that's only the tip of the iceberg, guys, when it comes to the math, okay? Because we're going to be doing a little bit more as we go. Everybody clear on our approach here going into each trade that we're going to be looking at? Good. Daniel says, yes, it's very clear. Awesome. Okay. So the indicator that I'm going to talk about here today is ATR, average true range. Okay, just a quick description here. It was developed by Wells Wilder. Wells Wilder also developed the RSI indicator. Very good indicator, good oscillator, good indicator identifying overbought, oversold price situations. Average true range was designed to measure volatility. So going back to a few slides earlier where I said that we are going to account for volatility on each individual trade that we're in or trade that we plan on placing to help us determine when to exit. You guys might be doing this, and I'm not saying it's a bad thing to do. You might be, let's say you have a 5-stock portfolio. Maybe you're using a 10% trailing stop on every stock in the portfolio, or maybe a 30% gain or 10% loss. A profit target, stop loss percentage on every stock. And there's nothing wrong with that. There's a ton of trading systems that we have that works very well. What we're going to do is just tweak that a little bit. And what I mean by that is we are going to treat every position differently, every stock in our portfolio differently, because every stock's volatility is different than other stocks, right? So we're going to be using this indicator, average true range, which again was designed to measure volatility. And it's a moving average of a combination of recent high, low, and closing prices. I'm not going to get into the calculation. If you want to Google ATR, average true range, it's a very tedious and frankly confusing calculation. I'm just going to really talk about the application of the indicator here today. So the application, as we are going to be looking at, will be the industry standard 14-day ASR, 14-day look back, 14 period look back, and we are going to be looking at daily charts. So it's a 14-day ATR, and again, that is the industry standard. It can be used as a way to exit a trade. We are going to be looking at that application of it, and it doesn't matter how the trade was made, okay? And I'm not going to be really focusing, guys, on, I might touch on it a little bit, but I'm not going to harp on or focus too much on entries here today. We're going to be talking about trade management after you get into a trade. What type of money management tactics you can use using average true range. And we're also going to focus on how the indicator aids in position sizing. Okay, aids in position sizing. So let me hop right into the program. I always like to do this. What's the market doing, right? Every time I'm live here and I don't spend a lot of time in the slides and I go into the VectorVest program, I just like to see what the market's doing. And unfortunately, A lot of red in the color guard over the last 3 days. We're in a confirmed down situation. The MTI has crossed from above one to below one today, and the markets are getting crushed. All right, so I reiterate again, very timely presentation, giving you guys some insights on how to sell and how to manage the positions that you are currently in. Okay, let's focus first on trade implementation, position sizing, and setting the right stop loss. So we know going in, let's say, take for example Etsy. It's a great stock, it's a great company. They just released earnings not too long ago. Okay, now it's unfortunate that the market reacted the way it did to their earnings report. They had a fantastic quarter, they had a fantastic year, record-breaking numbers in terms of revenue and sales, right? But their forward guidance was still good, but they forecasted their revenue growth to be, I think, about 25% over the next quarter or over the next year. I'm not sure, which is a little bit lower than expectation and a little bit lower than how they've recently performed. Etsy is a company that really thrived during the pandemic, right? 2020. We just pull this out. We're only looking at a 5-month graph, but boy, did they perform really well during the 2020 pandemic. It's an e-commerce company where a lot of people stayed home, and shopped, my wife included, right? Aided to their growth, Amazon as well. But let's just, for all intents and purposes, and I'm not saying that we are going to look to buy Etsy today or tomorrow, okay? Let's just say the market was in better condition, and Etsy is a company that you liked and you feel like you're getting a little bit of a bargain here. The stock did gap down a few days ago, formed a bullish Harami candlestick formation 4 days ago, and is still moving a little bit sideways. But again, it's not the entry that I'm going to talk about here today. What I will talk about here with Etsy is position sizing using ATR. Okay? So with Etsy, we're going to throw this stock into our portfolio. We plan on putting $20,000 into the position. We have a $100,000 portfolio. We don't want to risk any more than 1%, which is $1,000 on this trade, which is essentially leaving us with a 5% stop loss. So the question that comes up is, all right, is a 5% stop loss, does a 5% stop loss make sense given the current volatility of Etsy right now? Okay? And we're going to use average true range. So the average true range, the 14-day average true range as of today is $11.29. $11.29. That's what's known as a 1 ATR. Okay? 1 ATR, the average true range is $11.29. The application that we are going to be using here today is known as a 2 ATR, 2 times ATR, which is essentially $11.29 times 2. Let's figure out, though, first, what percentage that is of the current price. So here's another little tool I'm going to use here. Okay, $11.29. Told you we were going to do some math here today. Times 2 is $22.58. What percentage is that of the current price of the stock? That's what we are going to figure out here today. So I'm going to use this little percentage calculator, that I like to use to help determine percentages. Okay. David says about 14. All right. So you're right. Let's get specific though. Exactly how much is it? So we're going to go $22.58, and the current price of the stock is $160.05. $160.05. $22.58 is what percent of $160.05? That's 14.1%. So a 2 ATR leaves us with a stop loss of 14.1%. Well, that doesn't work, right? We want to use a 5% stop loss. We don't want to risk any more than 1% of our overall portfolio value on any one position that we take. We like Etsy, okay? Again, as an example, we like the upside, but a 14% stop loss does not work with our trade implementation and money management tactics that we are planning on using. So what do? Well, first off, we got to cut that in half, right? We got to at least cut that in half. We got to get that 14% down to 5%. How do you do that? Do you just say, you know what, I'm going to forget about Etsy, let's just move on to another stock? No. Now we're going to talk about position sizing. So instead of a $20,000 portfolio, I'm sorry, a $20,000 position, we have to at least cut the position size in half, right? So a $10,000 position would leave us with a 7% risk. Well, that's still a little bit too high. And again, we wanted to stay in the 1 to 2% area, right? Well, 7% is about 1.3%, 1.4%, or 1.3, 1.4%. All right, which is again closer to 1% than it is to 2% risk, but still we want to get to that 1% risk. What would be the total amount of capital that we need to invest in Etsy to get us to that 5%? We're looking at about $8,000, right? We're looking at about $8,000. That's unfortunately not the $20,000 investment that we were looking to put into the trade. Okay. Thank you, Colin. Awesome. $7,092. $7,092. Given the and let's focus on this, right? Given the volatility of Etsy in particular, we can't invest 20 grand into the position and use a 5% stop loss. Why? We'll get bounced out in a day. Doug says, where did the 2258 come from? Sure. Whoops. 2258 is 1 ATR times 2. Scott says, why are you forcing the trade versus finding a better candidate? It's not that Etsy isn't a good candidate. It's still a really good candidate. Okay? We are just position sizing the trade according to the volatility of the stock. It's not forcing the trade. We're taking the trade, but we are going to account for the volatility on the position. The very best professional traders in the industry don't give up on a potentially good trade because volatility is high. They adjust their position size based on the volatility of the stock. Good question, Arthur and Jerry. Why ATR times 2? It's just a kind of an industry standard approach to take. You guys have maybe heard of Chuck LeBeau. Chuck LeBeau is a very famous professional trader. He created a technique using ATR called a chandelier stop. It's essentially a 22 ATR times 3. Okay? But a very common approach using the ATR is just taking a 14-day ATR times 2. That's why we're using that. Look, anything more than a 1 ATR is unusual or abnormal volatility. So we're going to go with 2. We're going to go ATR times 2. Okay, and again, that's a very common application of the ATR indicator. You're welcome. Okay, so let's figure this out now. So we know, let me go back to my calculator here. We know that we can only invest about $7,000 into the trade. We still like the trade. We're not going to risk more than 1% of our overall portfolio value on the trade. What's 14% of $7,000? $1,000. So we're accounting for the volatility of the stock itself. We're still going to trade it, but we have to invest a little bit more money and adjust our position size based on the volatility. So $22.58 is 2 ATRs. So $22.58 less our purchase price. So let's just assume it's $160.69. Where do we set our stop loss? We set our stop loss $160.69 minus 22.58. Let's do the math. Let's go 160.74 minus $22.58 equals $138.16. $138. I'll get there. And I was just there. At 16 cents, 17 cents. That is where you would set your initial stop loss. Okay. Ross is asking, so do we not take notice of the VV stop loss? It's an entirely different approach. We are focusing on this this strategy here of using ATR. I don't want to conflate things and kind of add in different layers here. Okay, we are going to focus here on using that ATR indicator to help us position size and setting the right stop loss, and always focusing on the 1% rule to start with. How do we abide by the 1% rule, but also account for volatility? I'm going to say that again because that's very, very important. How do we abide by the 1% rule and still account for volatility? If you say, let's forget about ATR, I'm going to put $20,000 into the position, and Jerry told me I'm going to set a 5% stop loss because I don't want to risk more than 1% of my overall portfolio value. Even one ATR, you are likely to get stopped out in a day. Because one ATR is what? 7%, isn't it? Right? If two ATR is 14%, one ATR is 7%. That's one ATR. We can't take the trade. You can't go into a trade with the amount of volatility that's present at the time. Just blanket, kind of a blanket entry of $20,000, 5% stop loss. That's why I said earlier, we are going to account for each stock's volatility when not only managing trades, and I'll get there in a moment, okay, but also trade implementation, position sizing, and setting the right stop loss. So that little exercise there, guys, is how you set the right stop loss and how you adjust for position sizing for each individual stock. Let's take Ford. Let's take another example here. Again, I'm not saying we're going to buy Ford today, but Ford's a good company. They're getting into the EV space a little bit, right? $11.40 stock price currently. One ATR is 35 cents. One ATR is 35 cents. Two ATR is 70 cents. Let's pull out my calculator again. So what is 70 cents of $11.40? 6%. 6%. So we're right, almost right there. So can we put 20 grand? This is again 2 ATR, right? 70 cents is 2 ATR. 2 ATR of the current price of the stock is only 6%. Okay, so can we put 20 grand into the position? No, not 20 grand. But we don't have to cut it in half or more for this particular stock. We can put about, 18 grand in there. James says, where are you coming up with 20,000? James, you might have came in a little later. We are going into each trade assuming we are going to put $20,000 into each position, $100,000 portfolio, not risking any more than 1% of the overall portfolio value on any one position. You're welcome. Daniel says $16,286. That is how you adjust or adjust your position size based on the volatility of the stock. Okay, so $16,286. Stuart says, how did you arrive at 16,000? It's essentially, and Daniel, if you don't mind sharing the math so I can share it with the group, $16,286 allows us to not risk more than $1,000 on the trade and still stay with that 5% stop loss. Okay, I can't put 20 grand. If I put 20 grand into the trade, right, with a 5% stop loss, I'm still not going to risk, yeah, Daniel says divide 6.14 times 5. Okay, I'm still going to risk, I'm not going to risk any more than 1% on my overall portfolio value on the trade. Well, what's, again, 5% is less than 2 ATR, which means I will likely get stopped out in 2 days. Okay, if I kept it with a full position size. You're welcome. So 70 cents minus $11.40 gives us what? This is easy. So it's $10.70. $10.70 is my initial stop loss. Doug says, is it wise to put a $100,000 portfolio into only 5 stocks? Sure. Anywhere between 5 and 10 is a good number. Okay. If you're more comfortable with 10, Doug, then you would go with 10. But just for me, I like managing a 5-stock portfolio. It's very easy to manage. It doesn't matter how many stocks you're managing. You're still not going to risk any more than 1% of your overall portfolio value on each stock. Okay, so $10.70 is my initial stop loss on Ford with a $16,286 initial investment. $1,000 of $16,286, I'm in good shape. Okay, let's do one more. Curaleaf. It's a cannabis company. One of the better ones, to be honest with you. They just recorded, they just had earnings. Do we have earnings on Pink Sheets? Yeah, they just had earnings not too long ago. They expect tremendous growth in 2021. One of the really, the better, cannabis companies out there. Okay, so $14.54 is the current price. 74 cents is 1 ATR. Okay, so $1.48, that's easy math too. $1.48 is 2 ATR. So $1.48 of $14.56. $1.48 of $14 and what I say, 56 cents. 10%. 10%. This one's easy. You cut the trade in half, right? Instead of $20,000, you cut the trade in half. You're still going to apply the 14-day ATR times 2 to account for the volatility of the individual stock, which is 10% of the current price. So we can't put a 5% stop loss on $20,000. We can put a 5% stop loss on $10,000, and we are in line with our initial risk management approach. Jay says better than GRWG. GRWG is another good one as well. I like Cresco too, but that's besides the point. So this one is an easy calculation. 2 ATR, which is $1.48, is 10% of the current price. If I wanted to put $10,000 into 20 grand into the position and use a 5% stop loss, that doesn't work. I get stopped out way too quickly. So I just have to adjust my position size. And in this one, again, is easy because you just cut it in half. Okay, so instead of putting 20 grand in, you put $10,000 in, and again, you're in line with your money management rules. Okay, so very easy to calculate. Well, what we first did was calculated what our initial stop loss percent is based on the parameters that I laid out. And that same formula there, you just use, for any amount of money that you're trading and the number of positions that you want to hold. Okay? So a $50,000 portfolio, 1% of that is $500. So you're not going to risk more than $500, not invest more than $500. You're not going to risk any more than $500 into each trade. Okay? So now let's talk about using ATR, using a 14-day ATR to help us protect profits. We've gone through the application of it to ATR to help us determine our position size and our initial stop loss. Okay? Now we are going to talk about money management while in the trade. And again, we're not going to really focus on how we got into the trade. Bruce, good question. Bruce says, ATR keeps changing. Do you adjust your stops to accommodate the changed ATR? Yes, not your initial stop. Your initial stop is based on the current ATR the day that you enter the trade. But you're right. As time goes by, ATR keeps moving, right? It's a moving average. So here's a good example. Here's Pulte Group. Okay? No matter when you enter this trade, this is a nice bullish Harami here. Nice breakout recently above this consolidation period after a new high was developed. Relative timing was above 1 and trending higher during that time. Stock was a buy rating. So again, we're not going to really focus on trade execution more as much now as trade management. So how do you apply a 14-period ATR times 2 to an existing position that you're in to help you protect profits or cut your losses, just depending on when you enter the trade? So what a 14-period ATR essentially is a trailing stop. Okay? And it trails off of the highest price achieved since you entered the trade. So on 5/10, okay, no matter when you entered the trade prior, 5/10's May 10th high of $63.91 is the highest price achieved since the trade was executed, right? Well, let's figure it out. 14-day ATR times 2, as of the highest price achieved since you entered the trade, is $1.58. Let's round that up. $1.58 times 2. $1.58 times 2. $3.16. So essentially, it's a $3.16 trailing stop off of the highest price achieved since you entered the trade. So $3.16 minus $63.91, let's get specific. $63.91 minus $3.16 is $60.75. A 14-day ATR times 2 allowed you to exit this trade because volatility is abnormal at this point, a day off of the actual high, because as you can see, the low price on that day was $59.15, below your $60.75 level. Okay? And it's going to change, so ATR, 14-day ATR changes every day, but so does the price, right? So after each new high that's established, so let's say here, for example, okay, on April 28th, that was, if this was the hard right edge, that was the highest point achieved since you entered the trade. So as of that day, the 14 period ATR was $1.48. You multiply that times 2. That is $2.96. If price fell $2.96 off of the high of $58.89, let's round that up, that it would have stopped you out. It's a 2 ATR trailing stop off of the highest price achieved since you entered the trade. Penny says, if you bought below the high point but didn't put a stop on until the decline, does the trailing stop go off the highest price, the current price, or the price at which you enter the trade? The highest price. That's where the trail is implemented from. Not your, remember, you're setting an initial stop loss and adjusting your position size based on the price that you enter into the trade and 2 ATR. So what you're assuming there, Penny, is you enter a trade below the high and then it immediately falls, or not immediately falls, but it eventually falls 2 ATR off of the highest price achieved since you entered the trade. So you're assuming that that will happen, pretty much immediately. Then you exit the trade. Yeah, Vinay says, what happens when you enter a trade at the highest price? Then that's the highest price achieved since you entered the trade. Yes, John. John's asking a question. Is there a way to set an automatic stop for 2 ATR or set an alert for that? Yes, the Genius does that. We have an exit criteria. Let me go into the program real quick. Just go to any old portfolio here. It doesn't matter. If I go to edit, this is just a portfolio that I have in my account. If I go to edit, this portfolio uses a 50 gain, 20 loss. If I go to customize trading system and go to my stop criteria, here's your trailing average true range stop. You just have to adjust the settings here. So instead of the default is a 10 period multiplier with a 1 multiplier. You just change it to a 14 with a 2 multiplier, and now you have an automated system, guys. I am going through, obviously, it's not necessarily the manual way. It doesn't have to be the manual way. It's the system that I'm teaching you here. John says, very cool, thank you. Yes, what I'm teaching you is how the exit or how the stop is calculated and implemented. Within the Genius, you can automate it. You can automate it. And as time goes by, the 14 period ATR times 2 keeps adjusting after each new high that is achieved since you purchased the stock. And yes, you will get alerts when that 14 period ATR times 2 falls below the highest price achieved since you purchased the stock. Okay, let's look at UNH. Okay, UNH, very similar situation here. When are we going to exit? Did we exit yesterday, or are we going to exit today? Volatility is picking up. You could see actually the 14 period ATR here. I know it dipped a little lower today, but it really started to pop here with yesterday's price action. So 3 days ago, stock price hit a high of $425.98. Clearly, if you bought it anywhere back here, that was the highest price achieved since you purchased the stock. Right? Maybe, well, actually it was here. If you purchased it anywhere in this area here, this was the highest price achieved. So on this day, for example, the stock hit a high of 401.48. One ATR was $7.12. $7.12 times 2, because we're using a 2 ATR. And don't worry about having to do this, guys. Again, I'm showing you this because I want you to understand how it's done and how the trade is going to be managed. But You don't have to worry about calculating any of this. If you put it in the Genius and set a 14-period ATR times 2, it does all the work for you. It's going to recalculate every single day. So a $7.12 one ATR times 2 is $14.24. So if this was the highest price achieved since I entered the trade, $401.47, 401.47 minus $14.24 would have given me a stop value of $387.23. Thank you, Vinay. Okay, 387.23. So a new high was achieved, wasn't it? So it will no longer use the $14.24, which was the 2 ATR at the time, or as of 4/21, which was the highest price achieved after we purchased a stock. It's going to recalculate because we've achieved a new high. And that's what the Genius will do for you. Okay? And it doesn't look like we see another new high. Doesn't look like we exited anywhere in this area. Another new high, more new highs. It continues to recalculate after each new high. So this is now the hard right edge, where $425.98 was the high on May 10th. And a 1 ATR was $5.76. Multiply that times 2. Now we're looking at $11.52 trail off of the highest price achieved, $4.25. I'm sorry, $425.98. So that is $414.46. Look at that. That's right? Yep, $414.46. We exited the trade yesterday, a day off of the actual high. Why? Because we are now entering into a very abnormal and unusual period of volatility. Okay? Exiting yesterday as it goes below that $414.46 level would have resulted in us capturing some really nice gains and not finding ourselves in a situation where volatility is really starting to pick up and we're just going to hold on to the trade for any longer than we need to. Okay, Ross says we don't have VV real time in the UK, so can we use the Genius for alerts? You still can, Ross, but it's just going to be on an end of day basis. Bruce says, have you actually used the stop system? How do you like it? I love it, and yes, I have used it. Okay, and I'm starting to use it a little bit more now in our swing trading coaching group that I help facilitate every Thursday. Okay, it all goes back to not risking more than 1% of your overall portfolio value on any one position, using that as gospel, but using this indicator here to adjust your position size, set the right stop loss, initial stop loss based on the volatility of the indicator, okay? And then also it aids in helping manage trades when volatility starts to pick up, and it just serves as a nice trailing stop, but it's just not a percentage trailing stop. Right? It's just not a 5% trail or a 10% trail. It's a trail that accounts for or includes the volatility at the time that the stock starts to pull back off of the high, the highest point achieved since you entered the trade. Doug says, exit when it hits or based on the close and exit the next day. With an indicator like this, because it's a volatility-based indicator, exit as soon as it occurs. So if we're looking at, again, if we were looking at $414.46, as soon as price falls below that, exit the trade, okay? Because again, it's the nature of the indicator that we're using. It's a volatility indicator. No need to just wait for the close and then the following day, because we already know that we are experiencing a point or a period of extremely high volatility. So Bruce says, I assume it works much better with stocks with a smooth graph. Well, it does. It works well with any stock because it keeps you in trends longer. It keeps you in trends that don't experience abnormal volatility periods. Ask yourself this. If you're in a trade and you have a good gain, do you want to sit in the trade during a period of abnormal or unusual volatility? The answer should be no, right? This indicator is really nice, is a nice indicator to help us manage those type of situations in a way that I don't think we can, either with the naked eye or just with a blanket trail. Stuart says, is the ATR calculated at the end of the day or is it an intraday indicator? It's an end of day indicator, but it can also be used as an intraday indicator as well. But the way we're using it is on an end of day basis. So it's calculated on an every day. If I go to a 1 day chart, you can still see this is a 1 minute, 1 day chart. The ATR is still a moving average of price, but now we're looking at an intraday chart. Okay, so it's just based on it's calculated based on the time frame that you're looking at. Okay. All right, guys. So what I want to talk to you guys about now, this is obviously one method. All right, using a 14 period ATR times 2, which is just industry standard, is a really nice way to position size according to the 1% rule and keeping in line with that 1% rule. Okay, and it also helps us take profits in turbulent times, in periods of low volatility. Okay, there are many different ways, techniques, strategies to implement stop losses. This is one, and don't think that this is the end-all be-all and one you should use exclusively. In fact, actually, what I just taught you here in terms of using the 14 period ATR times 2 as a trailing stop should be used in accordance with some other different money management tactics. You know, using support or understanding where support and resistance are, and other ways. So what I want to talk to you guys about now is a brand new course. It's called When to Sell. This course was developed by myself, Steve Chappell, Stan Heller, and Dr. David Paul. And what we are going to do is we are going to teach you the best techniques to know when to sell, when to exit trades, whether they be long-term investments or short-term swing trades, to bank your profits before they disappear. You know, you never want to be left with asking yourself the question of, what do I do? I hate this, but I still get those emails, unfortunately. I get the email of, what do I do now? I'm in this stock, what do I do? Guys, this course was designed to help you never ask that question of yourself again. You should never be left with, what do I do with this trade? You should know exactly when you're going to get out, even before you get into the trade. And this is what this course is designed for. And the 4 of us are going to be your instructors for this course. Never before, as far as I know, I've been with VectorVest a while, have we ever developed a course and taught a course with this many instructors. You ever heard Dr. David Paul teach? He's fantastic. So is Stan. So is Steve. So you really have a nice cast here of instructors that are going to take you through a number of different money management tactics to help you understand when to sell any position that you're in. So let's talk about the agenda. Okay, since this is a brand new course, never before taught, all of these modules that I'm about to go through here are going to be live. Thank you, Pierre. Pierre says, fantastic team. All of these modules I'm about to go through are going to be live. We're also going to do mastery sessions as always, but we'll talk about that in a little bit. Module number 1, I'm going to jump in. I'm going to kick things off with setting yourself up for success. We're going to talk about how to define objectives, because again, this is not a trader's course. This is not an exclusively or strictly investors course. It's for everybody. Okay, so we're going to go into the first module to help us define our objectives, market timing, risk management, and more so on position sizing, which is going to be a nice review of what we talked about today. Pierre says, already registered since the Financial Freedom Summit. Yeah, we launched this course during the Financial Freedom Summit. So, hopefully you guys have registered and are looking forward to it. So module number 1, great kickoff. Stan Heller is going to come in, and now he's going to teach about how to use moving averages as stop losses. He's going to teach the Guppy trading system, which is a very cool system using multiple moving averages. I think it uses 12 different types of moving averages. He's going to teach about the VectorVest stop price, which is also a moving average. Short and long-term exits using different types of moving averages, and then he'll teach about the 40-day moving average on RT. So this module number 2 is all about moving averages as stop losses. Okay, I'll come back in module 3 and teach you guys how to use technical indicators to pinpoint exits. Again, short and long-term exits. We're going to be looking at daily charts. We're going to be looking at weekly charts. You can use the MACD not only on a daily chart, but on a weekly chart as well. And again, we'll talk more about the ATR, average true range, in module 3 as well. So module 3 is technical indicators to help us manage trades. And Dr. David Paul is going to come in module 4, and it's called Stop Loss and Price Targets Using the Fibonacci Sequence. If you guys are interested in Fibonacci, there's no better instructor than Dr. David Paul to teach this approach. He'll go through the background and the history of the Fib sequence, Fib retracements for entries and stop losses, and then Fib extensions as well. And then Steve comes in module 5, trailing stops to navigate favorable price trends. He's going to focus on the Profit Locker Pro, just kind of define what's a trailing stop, and then also short and long-term guidance as well. And then module 6, developing your plan. The 4 of us are going to come together in this module and wrap everything up and make sure you understand everything that we've gone through over the previous 5 weeks, and that you leave with a plan to implement on any portfolio that you trade or invest in, and any stock that you currently have in those portfolios. So again, matching stop losses to your objectives is important. A 10% stop on every stock in every portfolio that you trade, I hope you understand now that that's not good enough. It might be sufficient, but is it optimal? And that's where we're getting at here. We're trying to make every trade that you place and every trade that you manage optimal. Okay? Also, we're going to have 6 live mastery support sessions after each module. Remember, the modules are going to be taught live. Obviously, these are live as well. These are great. They help you implement what you learned during the module. We'll look at what you're doing. If you can't make these, don't worry. You can submit questions. You can watch the recording. Everything's going to be uploaded into the VectorVest University as well. Okay. Also, 60 days access. If you don't already have the VectorVest program, if you're joining us via YouTube, maybe you don't have the VectorVest program. Pierre says keyword optimal. That's right. That's right. Not good enough or just okay, optimal. That's what we're getting at here, and it's really important that you guys understand that. VectorVest 7 intraday, you're going to get. If you have real time, you're not going to get intraday because you already have real time. If you have the VectorVest end of day program, we're going to give you the 60 days access to the VectorVest 7 intraday program, which is the 15-minute delayed. We're going to give you the Pro Trader tool as well if you don't already have it, which is a technical analysis scanning tool. Okay, so the regular price for this course, 6 weeks, 6 live modules, 6 live mastery support sessions, 4, in my opinion, very good instructors. Regular price is $995. The early bird rate is available for $795. But as a special bonus for you folks that are on this webinar today, whether you're joining us via YouTube or GoToMeeting, If you order before the end of today's webinar, and I'm going to stick around for a few more minutes, I'm going to answer some questions, but you get to register, guys, for $495. That's the best price that we will offer for this course. $495. Order before the end of the webinar. Oh, and by the way, this is a 100% money back guarantee. It says after the course is over, if you show you've done the work, and we'll know if you've done the work or not, if you've come to the classes, watched the recordings, you don't have to come live. If you watch the recordings, do any assignments that we give. If you're still not satisfied, if you don't think that anything that we taught you here will help you make more money in the stock market and help you manage trades more efficiently, we'll gladly give you the refund. The elite price is half off the $995, guys, Mary, Robbie, Khan. So the elite rate is $497.50, which, as you saw, is $2.50 more than the special rate available for this webinar. So if you are an elite subscriber, you either pay $497.50 or you pay the $495 if you register here. And go to that website, and I want to thank Ray, who I didn't introduce, guys. I'm sorry. Ray has been in the background answering your questions, but he typed in the chat box www.vectorvest.com/sell. He typed it in the chat box, so you can just click on it, and you will see the $495 rate there. Okay. Here are the dates for the live modules. Okay. Here are the dates for the live modules. They will all be on Wednesdays at noon, starting on May 26th. Wow. 2 weeks from today. 2 weeks from today, we will begin. Okay, May 26th, June 2nd, and so on for the next 6 weeks, starting on May 26th, excuse me. Okay, and then the live mastery sessions will be on the following days. Now, we initially scheduled them for Mondays, but then we realized there were a couple of holidays in there. So mastery session number 1 will be Tuesday, June 1st, which is the day after Memorial Day, and mastery session number 6 will be Tuesday, July 5th, which is the day after Independence Day observance, which is Monday, July 5th. July 4th is on a Sunday. Okay, so here are the dates again for the live mastery sessions. By the way, these are all on the university details page. So when you go to vectorvest.com/sell, you will see all those dates there. You will also see these dates in the email that you receive once you register. Thank you, Daniel. I appreciate that. Okay. All right, guys. Any questions at all? I'm going to stick around for a few more minutes. Any questions at all on anything that I talked about today? Luis says the 1 hour, 5-day chart is virtually useless. I need at least 10-day, 1 hour charts to see what's happening with the stock. Yeah, so we only have 5 days of intraday data. 5 days of intraday data. So sorry about that, Luis. All right. And Luis says, not all indicators work the same on every stock. I always look for the one indicator that moves the same way with the stock I'm working. Perfect. Perfect. You know, the ATR, again, is just a nice way to account for volatility. Is it a perfect indicator? Is what I taught you here today 100% effective in managing trades? I hope you guys know that nothing is 100% in this game that we're playing here. But you know, if you understand how volatility affects price, then you can appreciate an indicator that accounts for that volatility when managing trades. Okay, but there's a ton of different approaches here, guys, that we're gonna take. But just more importantly, that module number 6 is gonna we're gonna release you guys with a nice plan, no matter the portfolio that you're trading. Yep, Jay says, and don't forget Stan Heller's Guppy. Yes, that's in module number 2, Jay. Absolutely. Mondays are at noon. Did I not put that on the slides there? I'm sorry. I'm sorry. Modules are Wednesdays at noon. And I'm sorry, I didn't put the mastery sessions. They are at noon as well. Jerome says, is there a makeup mechanism for missed classes? Well, the makeup mechanism, Jerome, is the recording. All right, Roger says booked it. Awesome, Roger. Looking forward to working with you. Jerome, so Jerome, the recordings for all the modules and the mastery sessions will be uploaded to the university within 24 hours of delivery. So no necessary makeup mechanism for the missed classes other than the recordings which you get to watch. All right, Jerome says perfect, awesome. Pierre says, I'm impatient to begin the course. You got 2 weeks, my friend. 2 weeks. Now, unfortunately, there's nothing for you to watch, right? You know, this is a brand new course, so there's no content in there. Once you go into the university, guys, once you register, you go into the university, you're not going to see anything. It's just going to be a blank outline. Normally, as you guys know, if you take a course here, you know, we have a lot of content built in and you can watch it all at once. You know, my wife and I we're big binge watchers. We like Netflix, right? We like Hulu. And it is a little frustrating when you're waiting for a new episode to be released, right? Or a new season to be released. That's similar to this, you know. This course hasn't been released yet, so you just got to wait a couple weeks, which isn't terrible. James says, just got back, had to leave. Will this be available later? What do you mean by later, James? You know, so we're gonna teach this live now over the next 2 months. We'll likely do it again maybe next quarter. It just depends. It's hard to know. It absolutely will be available at a later time, and it also will be available on demand in the university. You know, I don't know, 2-3 months from now, once we're done, all the recordings will be uploaded. You can always, purchase the course and watch it on demand. Doug says, I am now registered. Awesome, Doug. Very familiar name. Looking forward to working with you. Mary says, how do we sign up? You go to vectorvest.com/sell. Right at the bottom there, Mary. vectorvest.com/sell. James says, recorded the ATR session. Today's session is being recorded, yes, and you will receive an email a little later today with the email with the link to view the recording. George says, registered. Awesome, George. Look, that's just a few. Anybody else? Look, if you're in, guys, if you're saying, you know, this is the course I've been waiting for, this is the course I've been looking for, this is the course I need right now, just type in I'm in or registering in the chat box. I'd like to kind of put a name to a student. All right, Pierre says registered. Jay says, I was going to sign up, but I lost the training money today. What's the market doing? Let's just take a peek. Is it any better than it was earlier? Let's look at the market timing graph. We're rallying off of the lows. Rallying off of the lows. A little better than when we first started here. What time did we start? Noon? Yeah, a little bit higher than we were when we started at noon. All right, Pierre says registered. Thomas says registered. Welcome to both of you. Looking forward to working with you moving forward. So just keep an eye on your emails, guys. Once you register, you'll get an email with all the information that you need to access the course. David says, I'm in. Brian says registered. Awesome, gentlemen. Dillip says registered. Awesome. All right. By the way, guys, look, my email address, jerryd@vectorvest.com. jerryd@vectorvest.com. All right. Shoot me an email if you have any questions about anything, from now up until the course, after the course, during the course, whatever. You all will have our email address, so you can correspond with us and follow up with us afterwards. David says, I'm in. Awesome. William says, I have the old course schedule. Can you send me a new schedule? Gotcha. Yes. So we had to make some changes, guys, because of the holiday, William. Yes, you will receive a new email with the new schedule. We'll get that out to you guys soon. Also, William, you can go to vectorvest.com/sell. I'll show you. vectorvest.com/sell, and the new schedule is right at the bottom as well. Okay, but we will be sending you an email anyway. You're welcome. All right, guys. Any other questions? Email me if you think of something later. But I really look forward to working with you. I've been looking forward to this course for a while, and today's webinar in particular. Hope you guys learned something, and I really look forward to working with you guys. Talk to everybody soon. Take care.